Ladies and gentlemen, please welcome our next session to the stage. Ladies and gentlemen, please welcome our next session to the stage.
Governor Miran, thank you so much for joining us today. We're excited for the conversation.
My pleasure. Thanks for having me.
So I wanted to start by talking about where in the economic cycle you see our economy right now.
Sure. So, my interpretation of what's happened this year is that growth in the first half of the year was, not as high as and I think a lot of other people would have liked to have seen it. There were some things that were dragging on growth. In particular, there's been a lot of people talking this year about uncertainty. I think that's very real. I think there was absolutely uncertainty about how trade policy was going to settle. I think there was uncertainty about how tax policy was going to settle and whether there'd be a very substantial tax hike if the provisions from the previous tax code were to expire at the beginning of next year. And I think that very much weighs on an economy. People wait to make an investment decision to sort of know, hey, is this going to be deductible? Is this going to be, can I expense this? Or are my customers going to have a big tax hike in the very near future? That weighs on things. I think a lot of that uncertainty has resolved with certainly on trade and with the tax bill having become law. And so I think that there's reasons why the first half of the year was weaker. And then you sort of see reasons. I also see reasons why I'm a little bit more optimistic going forward. I do think, because that uncertainty has been resolved, I do think it's important to note a couple things. One is that if the economy does well as a result of policies that push out the supply side of the economy, it doesn't necessarily have strong implications for monetary policy because potential output and actual output can move out by similar amounts, right? If actual moves by more than potential, then you have an output gap. The economy can be producing above or below potential, or more so than it was previously. But if potential and actual output move out by similar amounts, then there's not a clear monetary policy implication for it. I do think, at the same time, and this is something that we'll probably get to, one thing I've said in the past is that I think that the neutral rate has recently come down relative to where it was a year ago. That makes monetary policy more restrictive than it was, say, a couple of quarters ago. And that additional restrictiveness of monetary policy poses some risks going forward, because if policy is tightened, then with some lags to policy, you would expect the economy to weaken. So in the near term, I'm not very pessimistic at all about the economy but I do see some risks lurking there if we don't adjust policy.
Okay, so risks potentially lurking if you don't adjust policy. What are the signals that you're looking at to, establish whether or not policy needs to be, changed?
You mean sort of whether my view of where appropriate policy should be changed?
Yes.
Yeah. So, I guess sort of let me make a couple comments, right? One is that obviously for the very short-term appropriate policy path, there was a pretty big gap between my views and the rest of the committee, right? I think on a lot of other items, there was smaller gaps. And so it basically comes down to an extent of how fast I want to get to neutral versus relative to some other members of the committee. We sort of look at where are all the different projections in the summary of economic projections. Part of that is because my view is that monetary policy should be forward-looking. Policy works in the economy with lags, right? It's not the case that you change the Fed funds rate and then immediately the next day there's a big shift in the economy. It takes time for changes in the Fed funds rate to filter through into broader financial conditions. It takes time for broader financial conditions to filter through into the economy. That leads to what economists famously call long and variable lags of monetary policy. And there's discussions about how long those lags are. Traditionally, people interpret them as being about 12 to 18 months, sometimes 2 years. Recently, there's been people arguing that lag time has shortened. But the result of those lags is that policy has to be forward-looking. You need to set policy not necessarily based on where the data were 6 months ago, but where you think they're going to be 6 months to 2 years from now. depending on your view of how long those lags are. So one reason for why my sort of dot for 2025 sticks out so much from everyone else's is because I'm more sanguine on the inflation outlook than a lot of other people are. A lot of my comfort on the inflation outlook comes from the disinflation I expect to occur from housing services. Housing is the biggest component of the way that we measure inflation. It's the biggest component of the way of a lot of people register the cost of living. And housing inflation has been running, I would say, above in measured inflation has been running above where new leases have been set for a long period of time. And so let me just flesh that out a little bit. The way that shelter inflation is measured in the CPI data, and therefore that also passes through into the personal consumption expenditures data, which of course is what the FOMC has decided to look at primarily, is that it's based on what you would call average rents, right? And so the idea is that you look at market rents, you just go to Zillow or whatever, and you look at market rents. That's not necessarily the rent that people are experiencing on a day-to-day basis because they don't reset their leases every day. You reset your lease once a year, once every 2 years, once every 6 months, it varies. Different people reset their leases at different times. But what this means is that if there's an increase in market rents, right, so the price that you see on Zillow goes up, it could be 6 months, a year, 2 years until you experience it. And the CPI data reflect what you experience in rents. And so they don't record the increase in rental inflation until your lease resets. And of course, there's a lot of stuff going on in the background, and it's more complicated than that, but that's basically the intuition. What that means is that there's a really long lag between when you see market rents change and when measured inflation catches up to market rents.
So what is happening in the housing market that you believe will cause, the housing inflation to cool?
So I think that there was a big catch-up period by which the increase in market rents happened a few years ago, and it took several years for measured rents to catch up to them. That catch-up period is now done, which means that average rents and the rent that in measured inflation can now catch down to where market rents are. And market rents have been growing at about a 1% pace for a couple of years. So there's reason to expect that measured rent inflation comes down to where market rents are. And it's that comfort around the inflation forecast that gives me, around shelter inflation, aided by, and I've talked a lot about this, by the very significant changes in population growth that also, in my mind, decrease shelter inflation. That comfort around housing, which is the biggest component of inflation, gives me comfort around the inflation outlook, which allows me to sort of say, whatever is happening short term that's above where inflation should be on a backward-looking basis or even on a very recent basis, right, will be drowned out, in my view, by this coming shelter disinflation. And so you asked me what would make me change my mind, and it would be, and I had to go into all this because it would have to be something that made me change my view that the coming disinflation in shelter, in housing services, is going to be significant enough that it overwhelms other components of inflation that might be running higher than you want them to be.
So you talked a little bit about wanting to be where the puck is going to be rather than where the puck is right now. How would you view your perspective in terms of how far out the Fed should be forecasting and responding versus what the Fed has historically done?
Yeah, so that's a great question, and it comes back to how long do you think the lags are. I don't think there's a very scientific way of answering that question, and maybe the lag changes actually over time. It can be longer in some times and shorter in other times. But I think that it makes sense to think a couple years ahead, probably more like a year and a half. And this is sort of a tension that, a lot of people want to be, sort of like, are you data dependent or are you forecast dependent, right? And if you're acting purely based on incoming data, well, a lot of the incoming data look back 6 months, a year, maybe sometimes more than that, depending on exactly what you're measuring and what you're measuring and how. And there's a question about whether policy should be made based on what the data right now say happened over the last 12 months, or should policy be made based on your forecast for the next 12 months, which may be affected by current data, right? Mm-hmm. And so this is a bit of a tension, and the more confidence that people have in their forecast, the less weight that they would tend to put on sort of what happened yesterday, but if they have not a lot of confidence in their forecast, then they would tend to put more weight on what happened yesterday.
Okay. You had mentioned it earlier. I want to talk a little bit about where you perceive the neutral rate to be right now.
Sure. So by my calculations or my attempts to figure out that question, and I think we should be humble about this because the neutral rate is not observable. It's not something that you can sort of go out and touch and feel and measure. It's something that is a theoretical construct, but nevertheless it's a construct that's necessary to run monetary policy. It's basically, where is monetary policy neutral, right? If you're at the neutral rate, you're not stimulating and you're not restricting. You're not hitting the gas or the brakes. You're just coasting, right? And so you can't really observe that, but it's still a critical concept. Now, my best attempt to answer that question comes to about 0.5%, a real neutral rate of about 0.5%. I do want to sort of caution that we should be humble about our ability to know these things. By no means am I wedded to that specific number, but it is the number that comes out of my attempts to do so. Now, I think where I have a little bit more confidence than exactly what is the right number is more the question of how has it changed recently. And this is an area where I feel that I have somewhat differentiated views from a lot of other people, in that I feel that last year, because of various factors that were pushing it higher, like population growth, like expanding fiscal deficits, I believe it was much higher, and then sort of meaningfully higher. And then this year, because there's been reversals in a number of policies like those, I believe it's come lower. And so if you don't know exactly where the neutral rate is, which I do agree we have to be humble about that, I do feel that it's easier to sort of sign where it's gone recently as a result of very substantial changes in the economy that occur either for policy or for other reasons.
Yeah, and along those lines, before you entered government, you had been an advocate for increasing rates, and pretty significantly so, to tackle the inflation that the economy was seeing at the time. What has changed your perspective over time to being where you are today?
Yeah, so there are a number of factors which I believe that were pushing up the neutral rate last year. Some of those are still in play, and some of them have reversed quite substantially so. I just mentioned population growth due to changing border policy, immigration policy, changing fiscal deficits. If you look at so we expanded the fiscal deficit quite substantially, which was an increase in net national borrowing. And now the deficit has begun to decline. If you look at the fiscal deficit from February through August of this year, the data that we have that are available that are subsequent to the changes in policy that I've mentioned before, it's about $400 billion lower at an annualized run rate, and that's before the tariff revenue has completely set in, right? So these are substantial changes in some structures of the economy. And of course, there are other things like artificial intelligence, which is probably also pushing up neutral, but in my mind, extraordinarily difficult to measure. And I think that economists are probably not great at measuring exactly. Economists are not great at predicting the future of technology and the structure of the economy. And I don't want to pick on individuals, but people have famously in the past sort of said things like the internet will be as effective as the fax machine or something, right? In fact, it was much more substantial than that type of thing. And so I do think that something like AI can be pushing up neutral, but I think that I haven't seen a credible quantification of that effect. And let me just give a little bit more numbers, right? So if you sort of go through my analysis that I gave in my speech at the Economic Club of New York, it indicates that last year I started with a neutral rate that was at the top end of the range of where other FOMC participants had their neutral rate. It was sort of tied with the other two people or whatever that were at the top of that range. Then I accounted for things that have changed this year, most prominently border policy and expectations of changes to deficits, and then it came down to the bottom end of the range of everybody else. In both instances, both my impression of where neutral was last year and my impression of where it is this year has basically just gone from one end of the range to the other. It hasn't broken new ground of the range itself. It's just that I view things as changing in the economy, and that would naturally push around the neutral rate. So if this is true, if I'm correct, then last year neutral was higher, and so policy was not as tight as we thought it was. Policy was looser than we thought it was because the neutral rate that's neither stimulative nor contractionary was higher. This year, if neutral has come down, then policy is tighter than we think it is because what matters is the distance between current policy and neutral. And so in my mind, that made providing significant accommodation last year through cutting rates, or equivalently removing restriction through cutting rates, not necessarily the right move, whereas this year, it is the right move.
And, but if you do overcut, you could see asset bubbles and, other overheating in the economy. What makes you less concerned that you might see that outcome as a result of more significant rate cuts?
Yeah, you could see a variety of consequences if you make the wrong policy decision, right? So if you cut and cutting is the wrong move, right? You could see what you're describing of asset bubbles. I don't feel that I'm particularly well equipped to identify those relative to many other people in this room who are probably much better at that than I am. But one of the things that you might expect to see is some sort of penalty from the bond market, right? If long-end bond yields move higher as a result. I think arguably that happened last year. And so, for example, if you look at, I think it's been about 14 trading days since the FOMC in which we, last month that we cut rates, right? In those 14 trading days, 10-year yields have gone up by 7 basis points. In the equivalent 14 basis points last year, 10-year yields went up by, I think, about 5 times as much, about 34, 35 basis points, right? So that's a very substantial difference. And then after that, 10-year yields continued to rise up, almost like 110 basis points to their peak in, I think, January of this year. So that's a type of signal that that you might want to sort of say, hey, is there a reason why I might be wrong, right? Mm-hmm. I'm not saying that you necessarily agree that markets are always right, because markets are prone to excess volatility. Mm-hmm. But it would make you ask the question: Did I make the wrong move? Was I wrong? Do I need to reverse myself? Should I stop and reevaluate? And I think that the reaction this year has been very different than the reaction last year. So I would actually argue that the bond market behavior last year bore out my argument, and this year, thus far, it is again bearing out my argument.
So I want to continue on the topic of long-term rates.
Yeah.
What can the Fed do to influence long-term rates to the extent that you believe that that's a goal?
I have a personal preference for completeness, and so when I'm trying to sort of analyze a problem, I tend to sort of list everything that I think could possibly be relevant. And this gets me into trouble sometimes, as it did last year in that trade paper that I wrote, in which I listed every policy in the world that I could think of as possibly affecting the external accounts, and then people interpreted me as necessarily pushing individual elements of that, even though if you pulled any two items that they'd contradict each other, right? Mm-hmm. It was sort of a catalog, and it's just a preference for completeness when I'm thinking through a process. And earlier this year, in my testimony in front of Congress for the confirmation hearing, I literally just read out the Federal Reserve Act's tasking of the Fed's mandate, which is stable prices, maximum employment, and moderate long-term interest rates. I wasn't trying to reinterpret the Fed's monetary policy framework in doing so. I was just being complete and caring about democracy and the rule of law and what Congress has actually tasked the Fed with. Now, most people tend to think that moderate long-term interest rates will just naturally fall out of achieving stable prices and maximum employment. And I agree with that. I think that makes a lot of sense. So I think that moderate long-term interest rates is something that Congress tasked the Fed with, but it's something that you usually don't have to really think about because it falls out of achieving your other two mandates. So it's not something that I think the Fed needs to actively target on a day-to-day, month-to-month basis in normal circumstances. Mm-hmm. So therefore, you continue focusing on stable prices and maximum employment. That said, the Fed's actions do affect long-term interest rates because the Fed controls the overnight interest, the overnight Fed funds rate and associated policy rates that it uses to keep the Fed funds rate where it wants it to be, and those can affect the long-term interest rate through the structure of the yield curve.
And long-term rates have very significant impacts on things like housing, which you mentioned before. And
absolutely.
And so, does that factor into how you conduct monetary policy?
Well, housing is a very, very important sector, both because it is, as I said before, the largest component of measured inflation, of the way that we measure inflation, and for good reason. It's most people's single biggest expense is going to be their rent or the housing services that they consume through owner's equivalent rent.
Do you think that we should be concerned about, lock-in that occurred in the pandemic, and the lack of housing mobility that exists today?
Yeah. So as I said a moment ago, look, the Congress tasked the Fed with the items that I just mentioned, right? Ensuring a sufficient volume of transactions in a particular market isn't something that the Congress tasked the Fed with. That said, like what we've been tasked with is stable prices and maximum employment, right? Mm-hmm. And the actions that we take to pursue those can have consequences that may be unrelated, such as changing the number of, sort of affecting the number of transactions, transaction volume in a market like housing. So I think that it's unequivocally something that upsets a lot of people, right? The decline in transactions volume, but that itself is not something that we've been tasked to address by the Congress.
I want to talk a little bit about the dual mandate.
Please.
We are in a situation where you could potentially see the mandate in conflict. You have inflation that is running above the Fed's target. At the same time, you're seeing, the jobs market weakening. How are you thinking about the mandate? Does one part of the mandate get precedence over the other part of the mandate? And how does that ultimately impact policy?
Sure. So I view the mandate as less in tension right now than potentially some of my colleagues might. And part of that is because, as I said before, is I'm very forecast focused, and my forecast for inflation is more sanguine than some of my colleagues because I'm paying, I think, more attention to something like population growth, or maybe I'm giving it a bigger weight, or I think it has a bigger effect. And I'm also less concerned with the inflationary effects of tariffs as well. And so that's part of what makes me more sanguine on inflation than potentially some of my colleagues are. And so I view the mandate as less in tension than some others do. Now, that said, there inevitably will be times when the two sides of the mandate do come into tension. I don't think that now is necessarily one of those times, although some of my colleagues may. I can't speak for them. I can only speak for myself. If those two sides of the mandate come into tension, for me, it's always important to sort of think about why things are happening, and not sort of just to take in, not to just mechanically account for things that are happening, but to sort of ask why they're happening, right? The fundamental role of monetary policy to achieve its dual mandate is to balance aggregate demand and aggregate supply, right? Because if the one outstrips the other, then you end up with too much or too little inflation or employment, right? Mm-hmm. And so then the question is, why is demand outstripping supply, or vice versa? And then do you expect that to be a situation that persists for a long period of time? Or do you expect it to be a situation that will fade relatively quickly? And there are reasons why you might expect one or the other. And so, for example, if there's a substantial, sort of excess of supply or demand because of there was a pandemic and we locked down, and it was basically like a switch turned off the economy, and you knew that one day there'd be an antiviral or a vaccine or whatever that allowed you to sort of turn the switch back on and reopen the economy. That's something that you might say, okay, well then as soon as you reopen the economy, probably a lot of the effects will pass, right? If, however, and so therefore you might not expect it to be permanent, right? Mm-hmm. If, however, you think that demand or supply is outstripping each other because of a change in fiscal policy, that's going to sort of result in continued stimulus or the opposite, or contraction for a number of years, that is going to affect aggregate demand for a sustained period of time, and that you sort of don't think are going to turn back on the switch, 6 months later, then maybe you'd expect a different thing. So for me, there will inevitably be in tension, but it's really important to say, why are they in tension? What's driving demand or supply outstripping the other? What do you expect? Is it a natural disaster that you would expect to sort of, just turn off very quickly? Or is it one that you would expect to sort of last for a really longer number of quarters or years or something? And only then can you sort of say, okay, which side can you look through, if you can look through either of them?
And as you say, just for the sake of completeness, the third mandate, is that at all influencing how you're thinking about policy right now?
No, it's not. I mean, look, as I said, I think most people think that achieving moderate long-term interest rates will naturally come out of achieving maximum employment and stable prices. I agree with that. I could imagine there being, sort of tail scenarios of the world in which that's not the case, but I don't think that any of those tail scenarios are remotely describing, a reality that I see now or that I would expect to see.
So I want to switch gears a little bit to talk about government data, the confidence in government data. This administration has expressed a lot of skepticism in the validity of government data, and I just wanted to know where you stand on that. Do you believe in the accuracy of the data the U.S. government is putting out right now?
So, sort of to be clear, I think that there's always the need for nuance and interpretation when it comes to government data. When it comes to economic data in general. You always need to be careful when you're looking at economic data. Does what you're looking at really describe what you think it is, right? That's a really important question. And once you sort of, have that general caveat in mind, I do think that the U.S. government data have been and remain and will continue to remain the gold standard and the best in the world. In my mind, there has been some deterioration in quality in recent years, due in part to declining response rates. Response rates for, for instance, the current population survey or the establishment survey have come down by, I think, about 30 to 35% over the last, I think 10, 15 years or so. And that's resulted in revisions that are much larger than they used to be, and across some measures. Not every single measure, but across some of the very important measures. And so, for example, I don't remember these numbers off the top of completely off the top of my head, but I think the size of the benchmark revision has gone up by, I think, a factor of 10 or so. I would have remembered these numbers a few weeks ago, but I don't remember off the top of my head now. Other measures have gone up by much more than that, measures of revisions. And so declining response rates has been a significant problem for the reliability of particularly the first release of some of the economic data. This is something that I would hope ultimately get addressed and resolved and improved, but it's not it's not up to the Federal Reserve to do that.
Do you think it's important that the data be perceived as being politically independent?
Well, that the data are not manipulated for political purposes is what's important, right? People have to believe the data are reflective of the true state of the economy, and not doctored to achieve a particular political outcome. I do think it's important to have sort of democratic accountability, so that you can make sure that you are putting into place leadership that that sort of get to improving things over time. But that's not really a Federal Reserve issue that we would decide or address, and it's a decision for other people. But I do 100% agree it's absolutely critical that the data be reflective of the true state of the economy.
And are there other places that you look as you're developing your models and analysis and doing your analysis about the state of the economy that go beyond the government, the government data right now?
I think that the government data are the best quality we have, and they are the benchmark by which we do and should continue to set policy. During this period of the government shutdown, we are deprived of some of the data most of the data that we would need to be making monetary policy effectively. Fortunately, we only have to make a policy decision every 6 weeks, and so I would remain optimistic that we will have the data by the time that we have to actually make our decision at the end of the month. In the meantime, there are some private sources of data. I don't think any of them are really, they're good to look at while you have nothing else, but I don't think that any of them are really sufficient replacements for the government data.
Okay, and what do you do in the event that the shutdown continues and you don't have access to the information you need?
Well, as I said before, my view is that monetary policy should be forward-looking and should be forecast-dependent. And so, given the forecasts I have in mind, I would be looking for evidence that there was a reason why they might not come to pass. And so, I'm always looking for what might falsify my view for the future. Like, where would I be wrong? And as I said before, I think where would I be wrong is primarily, well, two things. One, if there's a lot more tariff inflation than I'm expecting, that's hard to do without the inflation data from the government. There are some private sources for prices, but I don't know if they're really reflective of the consumption bundles that people actually consume that get reflected in government data. And the other thing is, of course, the housing market. And this is an area where there actually is a reasonable amount of non-government data that can help, right? And so to the extent that a lot of my optimism on inflation is driven by the shelter disinflation I expect, this is something that I can sort of look for in non-government data. And thus far, at any rate, I haven't seen anything that would make me think that my view has to be materially adjusted.
Switching now to the political independence of the Fed, do you believe that the Fed should be free of political intervention and influence?
Yeah, I think that the insulation of monetary policy from the short-term political cycle in Washington, in short-term political cycle, full stop, is of critical importance. Monetary policy should be set for the goals that Congress has assigned the Fed for maximum stability and full employment and nothing else. Sorry, price stability and full employment and nothing else.
Are there any benefits to the administration having a say in Fed policy like rate setting?
Well, I mean, as I've said many times, I believe in vigorously interrogating one's own views and trying to figure out where I might be wrong. And I believe that I have been as transparent as possible about my views, right? And walking people through the math of why I hold the views that I do, and helping and sort of getting feedback about where might I be wrong, right? I think that's critical importance. I think it's critically important not to succumb to groupthink, not to live in a thought bubble and an intellectual bubble. And so to that end, I welcome all views on monetary policy. And I'm happy to hear all views about where policy should be set and why, and think about, hey, is there something there? Is there something that would make me change my mind, that would make me think the way that I was thinking about housing or tariffs or something else wasn't really right, and that I should adjust the way that I think about it, or the labor market wasn't really right, and I should adjust the way that I think about it, and that would make me change my views. And I do think that that is true regardless of the source of the views. I don't want to evaluate a view based on who said it. I want to evaluate a view based on whether it doesn't make sense or not.
You mentioned tariffs, so I'd love to dig in a little bit on your views on tariffs and inflation. So, as we talked about, inflation is above target. How does that jive with the policy being too restrictive right now?
Well, too restrictive right now is a function of one. As I said, I think that there are changes in the neutral rate between last year and this year, and two, my expectations for inflation in the future. I don't view tariffs as necessarily having driven a material portion of the inflation that we've seen thus far, and I base that view based on two things, right? The critical question is what's the in economic speak, what's the counterfactual you're using to evaluate tariffs? And from my perspective, the correct counterfactual for thinking about tariffs is things that aren't being tariffed. And so I look at I look at core goods, and then I say, okay, what are the core goods that are being imported that would be subject to tariffs, and what are the core goods that are domestically produced that would not be subject to tariffs? And you can sort of go good by good and sort of attribute parts of the value add to domestic versus imported, and then aggregate up. And I would expect, if tariffs were a material driver of inflation, to see overall core goods having a higher rate of inflation than imported core goods. And I do not see that in the data. The second counterfactual is, in my mind, that's relevant, is what is happening to core goods in other economies that are not engaging in tariff rate rises the way that the United States has this year. And when I look at a chart of core goods inflation in other sort of major developed markets, Canada, Mexico, the UK, Europe, I look at these charts and I would want to see some clear distinction between U.S. core goods inflation and most other countries. Right? And I would say, okay, it's not the case that these other countries are applying tariffs on the scale the United States is this year. And so therefore, U.S. core goods inflation should be materially above core goods inflation elsewhere, or have materially changed in the time of this year versus last year. Not on a 12-month basis, because then you have all sorts of weird base effects, right? Because where was inflation, in the second half of last year? Core goods inflation in the second half of last year. But looking at shorter frequencies, the things that have changed in prices since the tariffs got phased in. And again, I don't see any substantial divergence of U.S. core goods inflation versus the rest of the world. I don't see it when I look at the data. And so for me, I can't conclude that looking at those data that tariffs are a material driver of inflation.
Do you think that that's potentially because the impact of the tariffs has yet to filter through the economy in a as quickly as maybe estimated?
So it may. I've always allowed for the possibility that we could see some, and yet I have not in the data, right? And so it could be that the tariff inflation is yet to come, but I haven't seen it thus far in the data. And my impression of what happened in 2018, 2019 is that there was no material inflation at that time. Mm-hmm. And so given what I'm already seeing in the data this year, since the tariffs have been phased in, is, again, no material evidence of consumer inflation in the data. And so I think that the burden of the evidence is on the data to make me change my forecast, rather than assuming that it's going to come, given what we've already witnessed. So
continuing on tariffs, so you said that tariffs will help the U.S. government's fiscal situation. There's a case that's moving its way through the Supreme Court, and we're awaiting decisions. So if, for whatever reason, tariffs are undone, how do markets and the Fed recalibrate based on that new information?
Yeah, so to be clear, it's not for me to comment on the court case in particular. However, I do think it's worth observing that there are a variety of authorities in statute which enable an administration to enact tariffs and to control tariff rates. Some of them may involve more or less paperwork than others, but there's multiple authorities in statute. And so, what you're describing is a hypothetical situation that we'd sort of have to encounter if we got there. But my expectation would be that probably, and of course we'd have to see what happens if we got there, but we could change our, if we get to a situation like that, we'd sort of change our mind based on how things develop. But sitting right here, my expectation would be that, the government would probably get to a similar place just through different authorities.
Going back to the inflation target, do you feel like the Fed's inflation target is serving, monetary policymakers well, serving markets well right now?
So, I think that the Congress tasked the Fed with stable prices. Historically, the Fed has had leeway in how it interprets that. At present, the Fed interprets that as measured as a symmetric measured 2% personal consumption expenditure target. My personal view is that measuring inflation is extremely difficult. It's not something that we observe. It's an abstraction that's constructed. You can sort of touch this table and tell me what the price of the table is. You can't touch the general price level. You can't tell me what the general price level is. It's constructed. And so my personal view is that given that it's difficult to precisely measure, having such a precise target can lead to some micromanagement of rates. Now, that is not an argument for raising the inflation target. It's just an argument for low and stable prices, low and stable inflation. Not necessarily, clearly not at all, greater levels of inflation. But it's also my view that this is sort of like a big picture philosophical question without a lot of sort of short-term consequence. It's not something that I would think about changing right now, and it's certainly not something that I would entertain thinking about in a serious way, implying action until the Fed had met the target that it's already laid out for itself for a period of time. You want to avoid at all costs any appearance of moving goalposts.
So you've talked a little bit about how difficult it is to forecast the impact of technology on the economy. And I can't help but ask the question about AI because I feel obligated as a moderator of any panel to ask a question about AI these days. But there's a wide perspective around whether AI will in fact impact employment, whether it will increase productivity. Certainly, there's a ton of investment happening in the space right now. It seems like a major uncertainty that would impact any model that goes out in the years, given the rapid pace of innovation. How are you thinking about that right now?
Yeah, so there's two things. One is we mentioned this a little briefly in the R-star discussion before, but let me just make it a little bit more explicit. I do think that there's potential scope for AI to raise productivity growth. I think it's difficult to measure that. This is part of why my ex-ante R-star was at the high end of the range of everybody else's, was at the top of the range of everybody else's before I applied the policy changes that I analyzed to bring it down to the lower end of the range, that brought it down to the lower end of the range. And I think that's maybe reflected in some of the market-implied measures of R-star, which is why I ex-ante averaged together the model-implied and the market-implied measures. I think it's difficult for economists to measure this. I think economists have a really bad track record in general of being futurists and predicting, sort of future technology growth and the future of technology and how it's going to change the structure of the economy. Mm-hmm. We also don't know whether AI is actually going to boost productivity in general or just maintain productivity growth at the long-term averages. We've had general purpose technologies in the past as well, and yet we sort of still have long-term productivity growth statistics that have been affected by those technologies. We don't know whether AI is going to produce a ton of new investment that might otherwise not happen at all, or just supplant other investment that would otherwise be happening. So a lot of companies would probably still be building data centers, even if large language models were stuck in their 2015 state. They'd be investing in data centers for other types of new software technologies. And so we don't know exactly how it's going to affect a lot of the things that go into thinking about R-star, although we can guess a little bit in a non-scientific sense. We also don't know exactly how it's going to affect the labor market, right? There's a lot of doom and gloom stories out there, but again, I think it's important. I think it's important to be humble and to recognize that it's difficult to predict these things. They can go in any number of surprising ways. So, for example, there's been a lot of people talking about how social media has sort of taken a toll on some professions like journalism, for instance, right? But at the same time, there's now a lot of people who are social media strategists that wouldn't have had jobs if that profession didn't exist. And if you were analyzing social media in 2005, it would have been very difficult to sort of predict that effect on the job market. Or think of the parable of the bank teller. When the automatic teller machine was introduced, people predicted that it was going to lead to large losses of jobs in banks. But the fact of the matter is the number of bank tellers actually increased because now it became a lot cheaper to operate a branch, and so the number of branches exploded. And that's a way in which productivity growth leads to new activity in a sector that otherwise wouldn't have been possible. It frees up resources to do other things. And so I'm not saying that this is what's going to happen. I'm just saying that there's a long track record of economists making predictions on this with lots of certainty that they never had any right to and feeling embarrassed about it after, and I'm not going to do that.
Lastly, before we close out, I wanted to ask you, what don't people understand about how you think about the economy that you wish they understood about you?
I think that sort of a lot of my argument around sort of this neutral rate stuff that we're discussing.
Yeah.
We already talked about how I thought it was higher last year and how it went from the top of the range to the bottom of the range after sort of analyzing things that have changed between last year and this year. But the other thing that I think is really important to understand is that some of the things that I've discussed have actually been very fast moving by historical standards. People are used to thinking about something like population growth, which really is a substantial driver of neutral rates. And I don't think that's controversial. I think that's a widely accepted view. But it's normally something that moves very slowly. And so as a result, there's an attitude that you don't have to really think about modeling it because it becomes apparent over time and you know the long-term trends. But the shocks that we've had to population growth in the last few years are both the largest of our lifetimes in terms of magnitude, and also the fastest. Fertility rates change very slowly, very gradually, and so population growth rates change very slowly and gradually over time, and it's normally something that you don't have to think about because it operates in the background, it's so slow. But it happened like boop, boop in the last few years, right? And these shocks, both on the upside and on the downside, the biggest, right? In very, very, very fast succession. And I think it's incumbent upon us as policymakers, economists, to think about how that would affect the structure of the economy while it was going on. And and I think that may be an area where I have been a lot more focused on than a number of other people. But I think it's important. It was only a few years ago that we were having conversations about whether the entire world is going to converge to Japanese level interest rates because of similar declining population growth rates. Those dynamics never became not true, right? That channel has never been invalidated. It just got overwhelmed by other stuff, right? But now the other stuff is kind of receding.
Governor Miran, thank you so much on behalf of MFA and our members for joining us today.
Thanks for having me.
Thank you so much.
Ladies and gentlemen, please welcome our next session to the stage.